I think probably there are several reasons why people would short a company. I think with the first one that I can think of is that they just don't believe in the company, whether it's the product that's being produced or the service that's being sold, or they don't believe in the management that's running the company for whatever reason.
So
And
Beyond Meat may be an example of
yeah, that could
people not
be,
believing in the
yeah,
product.
yeah, Peloton would probably fall into that category at the moment too. There's just a lot of things about the company that people are all just like, no. It goes public and it becomes a public company. And then, there's the good and there's the bad to that. And when a company goes public, then it's out in the public. And so people can see all the warts, if you will, of the company, and things that may have done well when it was private. A lot of that stuff was uncovered, and as soon as you go public, now it's all out there for everybody to see. So any dirty laundry that you may have, I know that that's probably what the truck company, Nikola, more recently went through a lot of kind of dirty laundry scandal stuff when the company was trying to go public, because there was just a lot of, I guess, shadiness that was going on with management and the financials and some of those things. So I think some of those things really lead to a kind of a natural choice of shorting the company. I think another thing that could be is that sometimes I think it is easier to short the company because you just don't believe that it's going to grow, and it's probably more likely you're going to go the other way. And so it's probably an easier way to make money. And I think when you look at the share price of this company, it's trading around $10. And this is something I kind of postulated when Andrew and I were talking through this before we came on the air, was that because it's only trading for $10, it's an easier company for a lot of retail investors to take opposite bet on, that the company will do worse than it will do better, because there's not a lot of money involved. It's not like it's trading at thousands of dollars and you got to put a lot of money up to short a company like this. So there's maybe more potential to make money if the company does worse than they do if they do better. That's just something that I was thinking about. So I guess those are a couple things that kind of spring to mind. What are some of your thoughts now?
Yeah, those are all good. An interesting idea about the retail investors. I have seen a lot of kind of headlines talking about how a lot of average investors are really moving the market right now, which is
Mhm.
kind of cool. And you can move it not just through buying and selling or buying and shorting, but also there's a ton of options activity that really magnifies everything that goes on. And that includes when you see downward pressure. And so a couple other things that can really cause people to short. I mean, you have a whole subset of traders who call themselves technical traders. And there's a branch of that called trend following, where you just buy the trend. So you buy something because it's going up, you short something because it's going down. And so if a stock gets caught in one of those trends, it's a lot of times it is the fundamentals that drives it, but it can become self-perpetuating, and you can see
Mhm.
any negativity start to snowball into worse and worse negativity. If that picks up a trend, then you can see it getting worse and worse and worse. Another idea would be if a stock just got way too expensive, and if there was hype and then the hype went away. A lot of fads can be in that way. And if a company is in that situation, then that can explain the big short position. And of course, if people think that there's trouble with the company, if they think that it could go bankrupt or they're going to default in any way, then obviously you'll have a lot of shorts piling in there.
Mhm.